So somehow it's the last session of the module, last week of lectures for this semester. 13 weeks have passed and you've had to endure about somewhere between 30 and 40 hours of lectures, at least in this module. Countless more hours learning, doing the problem sets, thinking about topics that have been introduced to you. And the exam is in 2 weeks. So I will talk more about the exam, the format, and give you some guidance towards the end of today's session. For now, I just want to continue with where we left off last week. So today's lecture is really a continuation of interest rates, and we're going to morph into credit. Okay? The two are inextricably linked, so it's quite hard to split them up. Okay? But I have split them up, and if you remember last week, I talked about what an interest rate is, and you've all experienced it. You pay interest on your credit card or a home loan. But the thing is that different people pay different rates of interest. Okay? And that's the piece that doesn't make sense until you split it up into two forms of interest, two components of interest. What we call a risk-free component and a credit component. Okay? So if you're a risky borrower, somebody who might not repay a loan, you'll be charged a higher rate of interest. Okay? That's something you're all accustomed to. That extra component is the credit piece that we will talk about later today. Okay? For now, we've just introduced the idea of a risk-free interest rate. So even in a world where everyone is safe, there are no bankruptcies, no credit events, there's still a concept of an interest rate which comes from inflation, right? You remember? That's the macroeconomic. And I haven't released that essay that I mentioned last week yet, but I will probably do it today for you to read on if you're interested. It's not part of this module. Okay, so maybe get your exams out of the way, and then over the holidays, if you have some time, maybe read through it. Okay, it's not a long essay, 20 pages or so. Okay, so interest rates overview. What did we do last week? We introduced interest rates. Okay, we talked about 3 short rate models. Okay, and you need to be familiar with all 3. I think for the purposes of this module, there are many more out there, more complicated models. But the 3 that are tractable, the 3 that come up the most, the 3 that I introduced because they fit neatly within the stochastic differential equations that we have encountered are the Vasicek, Hull-White, and there's the Whole-E model as well. That's worth, it's not used all that much, but it's very useful to demonstrate basic concepts. Okay? But certainly the Vasicek model, you should be able to solve that. That's the Ornstein-Uhlenbeck process. Okay, you should be able to solve that stochastic differential equation. And then we introduced the idea of a risk-neutral framework for interest rates. Okay, we went back to basics. We set up the portfolio again. We did our delta hedging. We found out that the partial differential equation actually doesn't look all that different. There was a new term, this A term, which we had to introduce. And that introduced the idea of calibration. Calibrating the model to some market observed prices. And the market observed prices are the zero coupon bond prices. Okay? And the zero coupon bond is nothing but a contract that pays you $1 at maturity. And there are many of these. Okay? Maybe that's one of the major differences between interest rate modeling and what we've done so far with equity. With equity, day one, we started with ST. It's an asset. It represents a share in one company. That's it. It's one object. Okay? Here, we're in a world where our assets, zero coupon bonds, still evolve with time, stochastically. But here's the thing. There's now a whole spectrum of them. Okay? Capital T is now a parameter which defines which specific zero coupon bond you're talking about. Okay? And in continuous time finance, we assume that T can take on any continuous value. In practice, you only have a few of these observed in the market. Okay, it goes from maybe 1 month, 3 months, 1 year, 2 years, all the way up to 30 years. Okay? In practice, you might have about 30 of these different assets. Okay? But each one is an asset. Each one from one day to the next evolves randomly. Okay, so that's our asset. So already we're kind of in a multi-dimensional world. Okay? It's a bit more complicated to write down a stochastic differential equation for Z as we did for S. We had to do a little bit more work. Okay, that's what all this was about. We went back to basics. We derived the partial differential equation. We calibrated the model to this object, which is a curve. And we extracted the A parameter. And now we've got a framework to price any other derivative. Okay, that's the takeaway. Okay, that's what I want you to take away. The risk-neutral expression turns out to still be valid. Okay, this was all still. We still have a PDE. We still have an expectation. We still have risk-neutral dynamics. Okay. We introduced some basic instruments: zero coupon bonds, as I mentioned, fixed coupon bonds. Okay. The interest rate market is huge. There are many, many products, and credit, same, huge. We're going to cover the very basics, right? So, zero coupon bonds for this course you need to know. Fixed coupon bonds, okay, which are one of the biggest markets. The government, local, U.S. government or governments around Europe and around the world issue their bonds, and what they're issuing are fixed coupon bonds. Okay, you need to be very clear on what a fixed coupon bond is in terms of the cash flows. Okay, this defines the fixed coupon bond. All we're doing is discounting cash flows. If Z is a contract which pays $1 at some point in the future, C times Z is the value of that cash flow, that coupon. Okay? And Z of Tn is basically just the redemption of the bond. Okay? You get your $100 back. So day one, you buy the bond, you get coupons, you get $100 back. On day one, you may or may not pay $100, depending on the price of the bond. All right? And we introduced the idea of a yield to maturity. It's another important point. The price of a bond and the yield to maturity are two measures of the same thing. Okay? The price of the bond is just a dollar number. Yield to maturity represents the return that you get by investing in the bond. Okay? You think of the yield to maturity as your return. If you're an investor, you buy the bond, how much are you making? That's the yield to maturity. And this, remember, needs to be solved numerically. You can't invert, you can't extract y from this formula. So, normally if you have p, you need to extract y. You need to do it numerically. It's a root finding algorithm, of which you've seen two in this course. Okay, so zero coupon bonds, forward rate agreements, very important. Okay, and I'm going to go over that again in the next slide. Floating rate notes I introduced, but they're not very interesting. We saw last week that these are notes that pay a unknown floating rate coupon. Okay, what's a floating rate coupon? Well, ask yourself, what's the rate of interest you can lock in today? The rate of interest, if you had $1 to invest today for a year, is to buy a 1-year zero coupon bond. You know the price of the bond today. That's what you do. Floating rate notes pay that 1% floating rate, but every year. So every year you've got to wait until the coupon period start date, observe the bond, and that's how you work out the rate of interest. But we worked out that floating rate notes just have value $1 equals 1, right? Because if you think about the economics, all it is you take your $1, you roll it forward. You keep investing in zero coupon bonds. Okay, and at the end you've still got your $1 back. So they're not very interesting. They'll come up again later today, but there's nothing to analyze, right? The value is 1. We looked at options, and if you look at the notes, there are very limited discussions on options. It's beyond really the scope of this course. We're not going to be talking about options, but the point is that this framework, this risk-neutral framework, is so powerful that it can be applied to options as well. Where is it? Here. Any payoff. Could be an option payoff. Still works. Okay? The expectation might be more complicated to work out because this exponential is stochastic. If you have an option on a bond, the bond is also stochastic. They're jointly stochastic. So working out that is numerically, it's a nightmare. But you can do it, right? You see that there is a solution to this. And it's a one-factor problem because all the randomness comes from one Brownian motion. So really, this turns out to be a glorified integral, right? If I call it v of z, where this is something complicated. But guess what? It doesn't matter how complicated it is. You can discretize it. You can use Monte Carlo. Okay, so that becomes a numerical problem. At least economically, you know you have a solution. Okay, so those are the things that we have covered. Today we're going to introduce, I'm going to do a bit of review first, but we're going to introduce credit risk. I'm going to introduce the idea of swaps, probably not swaptions. I don't know why I even have that up there. But I'll introduce the idea of credit risk and zero curve bootstrapping. So last week I told you, take it at face value that this object here just exists from the market. Okay? Don't ask where it came from. Okay? You didn't ask me where ST comes from. You all accepted that there's such a thing as an Amazon stock. Okay? And its price moves. What determines? Supply, demand, economics of the company. Okay? You didn't ask too much about it. And really, derivative modeling is not about asking where S comes from, but asking about what we can do in terms of derivatives on S. Now we've got Z, and I told you last week, just assume it exists in the market, and it does. And we're going to be focused on derivatives on Z. But you have to do a bit more work. You have to set up a framework, you have to calibrate it. So calibration is one very important word. Okay, calibration. So we calibrate our model. And we're off. Now today I'm going to tell you about where the Z come from, because although I told you it's out there in the market, that's not the whole truth. It's not readily observed in the market. You've got to do a bit more work to extract it. Okay, but once you extract it, well, that's what it is. Okay, so where you would just observe a price of Amazon on a screen, you don't actually observe the ZT values on a screen. Okay, you observe something else, which you can then use to extract the ZTs. That process is called bootstrapping. Okay? So two really important words, buzzwords in this course and in quant finance in general, calibration and bootstrapping. Okay? If you decide to go into quant industry, you're going to be dealing with zero curve bootstrapping and calibration for the rest of your lives. That's what quants do, more often than anything else. Okay? Bootstrapping means extracting information from the market. Okay, and you saw it with forward vol. Okay, I think there was a question on the midterm, extract the forward vol. It's a bootstrapping process. Given information on the market, you extract information. Calibration is, given information in the market, how do I fit my model to the market? Okay, so they're different things, but they're both numerical tools that come up again and again and again in different contexts. Right, are there any questions from your side before we start? That was just a big, quick introduction. Today's really a continuation. And really the main thing, the big one, is a forward rate agreement. So maybe one other thing I should mention, and I did mention it, but I'll reinforce it. One of the reasons we're not going to be able to go very far in this course, in terms of interest rate at least, is because we've limited ourselves to one-factor models, one-dimensional problems, only one Brownian motion. Okay, so interest rates, you might think, well, interest rate moves one-dimensional, that's fine. Okay, it's the interest from today to tomorrow. But bonds, right, these assets that exist in the market, if you want to model them properly, you can't really do it with one Brownian motion. Why? Because Brownian motion will affect all the bonds the same. Okay, so what is Brownian motion? It's a random tick. What do we use it for? To model random ticks in our assets. If there's only one Brownian motion, if you think of Monte Carlo, when it ticks up, all the bonds tick up. Okay, that's not really how the market works, because short-dated bonds that mature in the next year versus long-dated bonds which mature in 30 years, they could behave very differently. Okay, you have this, it's back to correlation, right? With a one-factor model, you've built in this correlation of 1 into your model. When the world really behaves a bit more decorrelated, like long-dated bonds behave differently to short-dated bonds. You could be in a situation on a day where the short-dated bonds go up in price, but long-dated bonds go down in price. That happens all the time. It's a very typical movement of the yield curve. That can't happen. You haven't captured that behavior with this model. Okay, so any serious modeling needs multi-factor modeling. Any serious modeling of interest rate derivatives of the yield curve needs multi-factors. And we're not going to go into that, okay, because we're just setting the scene in this course. Okay, forward rates. So for now, just assume, we continue to assume that this continuum of Z exists, right? We just have it. We can trade any of them. And we set up a portfolio of one bond of maturity T1 and one bond of maturity T2. Sorry, not one bond, alpha bonds of maturity T2. Okay? And we pick alpha to be this special, it's just a number, right? It's the ratio of two prices. Okay, so this doesn't change with time. That's just you observe the two prices, take the ratio, and you buy one bond of the T1 maturity, and you short alpha units of the T2 maturity. Okay? This portfolio costs 0. Okay? It means it costs you nothing today to set it up. That doesn't mean that the portfolio is nothing. Immediately, you've now got obligations. Okay? First obligation is, at time T1, the first bond matures and you get your dollar. Okay? Because you're long the bond, so you get $1. At time T2, the second bond matures, and because you're short, you've got to pay out $1. But you're holding alpha units of that bond, so you've got to pay out alpha dollars. Okay, so what we've synthesized here is a loan. A loan which starts at time T1 and lasts until T2. Okay, so nothing happens today. But it's a loan. So if you're a company that knows you need to build a power station in 1 year, and it's going to take you 5 years to build this power station, you know that you need to take out a loan in a year and pay it back 5 years later. You can look in the market, observe on a daily basis what this forward interest rate is. And once you see an attractive number, lock it in. You can do that today. Okay. Of course, it means that if you wait a year and central banks decide to crash down the interest rates, you lose out, right? Because you've locked in alpha, or rather alpha minus 1 as your interest rate. Okay, but that's the case with all forward contracts, right? We saw it with a forward on an underlying stock. You lock in a price. If the price goes up in the meantime, you benefit because you get to buy it on the cheap. But if the price crashes, tough luck. You're still buying it at the forward price. Okay, same here. You're locking in. All you're doing is buying, but you're giving yourself certainty as to what interest rate you're going to lock in the future. Okay? You might decide you don't want to do it. You wait a year, see where interest rates are. Go to a bank and say, I need a 5-year loan starting today. That's the alternative. But the idea is that this forward, these discount factors, these Z's, zero coupon bonds, are normally called, they can be called discount factors because they're use them to discount future cash flows. Given that continuum, you can compute these forward interest rates. Okay? So you can compute interest rates spot starting today, and you can compute forward interest rates. This is the formula, which you should know, but really there's nothing to memorize here. Okay? If you understand the logic of what's going on, you can derive this yourself. This ratio is alpha, and alpha minus 1 is the interest rate that you end up paying. And delta, which I should probably make clear, delta is T2 minus T1. It's just a scaling to represent the interest as an annualized quantity. Okay? That's all it does. All right, so one thing we can do is, let's say T2 is T1 plus some delta. Okay? Let's take the limit as delta goes to T1. Okay. Let's take the limit as delta goes to T1. So if delta T1 to T2, if it's 1 year, in your mind that makes sense, right? It's a 1 year loan. As T2 goes to T1, and let's say in the limit you're at T1 plus 1 day, that's a 1 day loan, overnight loan. Okay? Now that's nothing you would ever have to worry about. We don't do that. People don't do that. But banks do that every day. Banks often need to borrow for 1 night just to meet certain obligations. Okay? On the 31st of December, there's a rush to borrow dollars. Okay? Many companies need for their year-end reporting to show on their balance sheets they've got enough dollars. So they go out and borrow it for 1 night. Okay? Sounds like, I don't know. Sounds like it shouldn't be allowed, right? But anyway, it's an accounting rule, and they can bypass it by showing that on that day, 31st December, they've got enough dollars. And they need to buy it for 1 day. So they borrow it for 1 day. All right? So this interest rate, this instantaneous interest rate, instantaneous means infinitesimal time. But in our world, infinitesimal is as good as 1 day. Okay? So this instantaneous forward rate, it's a neat mathematical construct, but it actually means something, right? Banks will look at this on a forward basis, look at the yield curve today, and in the same way you or a company might decide they want to lock in some interest rate for a loan, they might, based on their cash flows, know that they need extra dollars on 15th of July 2027 for whatever reason. They could lock in a 1 day loan or a 1 week loan, right? You just vary delta. And a consequence of this relationship is that identity. Okay? That's just calculus, rearranging. And a lot of people get confused about this. This is very different to the price. This is not a pricing formula or pricing expression. Okay? The pricing expression was an expectation, risk-neutral expectation. It was e to the minus r of s ds. Okay, there's no expectation here. R is the value that evolves randomly with time. Here you're integrating with S, okay? The second dimension of the yield curve, the capital T. All right, so just don't get confused with that. It probably won't come up anywhere, right? We're not going to do any yield curve modeling in this course, but if you do go into further study for interest rate derivatives, this becomes your underlying. Some models basically choose to model this instead of R. Okay, they're called term structure models. HJM, BGM, they basically model that quantity. Okay, we introduced LIBOR or floating rate note. I don't want to talk too much about this. But basically where in a fixed coupon bond you have coupon C. Here, for a given time period, Ti minus 1 to Ti, you only really know the interest rate until at time Ti minus 1. That's when you look at the bond prices and decide how much does it cost me to borrow for a year or for that time interval. But as we've just discussed and just seen, the kind of fair value of that loan is just the forward rate. Okay? If you were to estimate, okay, there's a stochastic quantity in the future. I don't know what it is, but what's my best estimate? Well, it's the forward rate. You can use the forward rate, okay, which is just this guy from the previous slide. And then you can rewrite it. Okay, so remember, P of fixed coupon bond, C, okay, that was the fixed coupon bond. This was given to you. Now you've got this expression instead, the forward rate. Each coupon could be different because it's a function of Ti minus 1 and T. Okay? But it's still a known quantity. Okay? Because this represents now what you think is the fair value of this floating leg, which can pay stochastic unknown future cash flows, but even though those cash flows are stochastic, after taking some expectation, or working out the forward rate, you can compute this expression. Now you can rewrite this. It's just algebra, multiply out the brackets, a whole bunch of terms, add them up, terms in the middle cancel. You end up with this thing equaling 1. Okay? So it's not interesting. Floating rates are not interesting. There's not really much to talk about. Okay? There's this other one. So this is a floating rate note where TI minus T1 might be 3 months, 6 months. Okay? 5 years ago, 10 years ago for sure, that's all I would have had. All these floating rates were coupon periods 3 months. Market has changed somewhat since then. So there's this concept of an OIS, overnight index swap. All that happens is that TI minus 1 to TI become daily quantities. Okay? They've just shrunk it. So it's a daily quantity. So your 3-month period where previously you just observed the price at the beginning and you paid it out at the end, now you observe prices every day. Okay? If this is going above your head, don't worry. It's not. I put it in here for completeness. Okay? Because this one, I didn't want to just leave it here because this is largely outdated now. Okay? But it's the same idea. This is still equal to 1. Same idea. Except now, instead of taking your dollar, rolling it every 3 months, you roll it every day. Right? Same idea. Okay, I want to spend just a couple of minutes. Who here has heard of interest rate swaps? You come across interest rate swaps? Okay. So this is a huge market. I could spend 3 hours just talking about interest rate swaps. Okay? But I'm only going to spend about 10 minutes just to give you an idea of what they are. We're not going to do any financial modeling. I'll have some complicated, scary-looking formulas, but what I want you to take away is the case for interest rate swaps. Like, why do they exist? And the case for them is this. Okay? You're a corporate company, and you need to borrow cash. Okay? To fund your projects, whatever. You go to a bank, and you borrow cash, and the bank tells you, you need to pay me interest every year. You need to borrow it for 10 years, say. Okay, it's pretty normal for a big corporate. Borrow it for 10 years, bank wants you to repay interest every year for the next 10 years, and repay the entire notional, or $100 back, in 10 years. Okay? So that's fine, you've got your loan, but you've got a problem. You don't like the uncertainty inherent in these interest rates. Okay? You don't know what it'll be. You don't know what you're letting yourself into. Okay? But the bank, those are the terms of the loan. It's called a floating rate of interest, a loan with a floating rate. So you go to a bank, JP Morgan. Okay, so now we have two. We've got the lending bank, and we've got the investment bank. You go to the investment bank and you say, you've got this loan where you have to pay a floating rate of interest. What you'd really like is just to, for peace of mind, have some certainty and lock in a fixed rate of interest. Okay? It's exactly the same with mortgages if you think about it. But how do mortgages work? You borrow money, there'll be a fixed period, 2 years, 3 years, maybe 5 years, where you know exactly what you're paying back. And if you do nothing, it switches to a floating rate. Okay? You end up paying whatever interest rate is live at that time. Okay? So you can see why companies would want to fix the interest rate. It's very natural. So you go to JP Morgan, you say you've got this problem. And JP Morgan says, great, what we'll do is we will pay you floating interest rates on your $100. In return, you pay us a fixed rate. Let's call it 4%. Okay? When I say let's call it 4%, JP Morgan will compute what it should be. So as a company, what have you got now? Well, you've got the bank. You need to pay them these unknown interest rate cash flows. But that's okay, because JP Morgan will give you those, whatever they are. So you just pass them along. And in return, you give JP Morgan 4%. Okay? From your perspective, you've basically engineered a loan where you're paying a fixed rate of interest of 4%. Okay? But it was only possible because JP Morgan stepped in and offered you this contract, which is called a swap. Okay? It's an interest rate swap. That's the premise. Okay? And the other way works too. Okay? Some companies have fixed obligations. They have to repay at a fixed rate of interest. But maybe they believe the central bank's going to cut rates. Okay? Maybe they feel that today interest rates are high, but I'm taking out a loan for 10 years. 5 years down the line, I think interest rates are going to be, they're about 4% today. I think they're going to go back down to 2%. I don't want to lock in 4 or 5% today. So they go floating. They swap for floating. Okay? It really depends on your perspective, what your thoughts are, what you want to, what your outlook is on interest. Right? That's what it comes down to. Okay, so that's really all you should know. You should understand the mechanics, what it's used for, what purpose it serves. Now you can split it up. If you're interested in a pricing formula, you can think of, so the interest rate swap has two legs. There's a floating leg and a fixed leg, right? If you think about it, you've got to receive all the floating coupons, that's one leg, and you've got to pay all the fixed coupons, that's another leg. So the floating leg is nothing more than what we've already introduced as a floating rate note. That's exactly what it is. Okay? I'm going to leave it. I know I said that the value of this leg, as complicated as it looks, is just 1. That's still true. But I'm just writing it here because I think this makes it very clear. It's very clear. There's an interest rate, it's discounted, and your redemption of your final loan. Right? That's the floating leg. And you have a fixed leg, which is Y%. Okay? This is what the investment bank will quote you. And this is just like a fixed coupon bond. Okay? Y% discounted every year going out to time M, 10 years, and your final redemption. Okay? So the interest rate, a payer interest rate swap, is a swap where you pay the fixed rate. It's just a convention. Pay means pay the fixed leg. So if you're paying the fixed leg, you're negative this one, and you're positive that one. Okay, I've just put the two legs together. That's now the PV, present value, price of the swap. And you can, do the calculus here. So it's not calculus, it's just algebra. And you get this expression. And in the same way that a fixed coupon bond, remember I said last week it's issued at par. Okay? It's just a convention. Interest rate swaps on day one are issued at par, which is to say that this PV is 0. Okay? It just gives you a deal which is of no value to either you or the counterparty. It's a fair deal. All you've really achieved is you've swapped an unknown cash flow for a fixed cash flow. Okay? You've gained, what you've gained is certainty as to what your cash flows are going to be. And you've done it at 0 value, so that's good. It may mean that Y is a number you don't like, but still, there is a value of Y which you can commit to, which will make this whole thing worth 0 PV. Now, it doesn't mean that it stays 0 PV forever. You come back tomorrow, this transaction now has a value. So imagine this. You've just gone to JP Morgan, you said you want to fix your cash flows, you don't want to pay the floating rate of interest, you want to pay fixed. JP Morgan says, great, 4%. And you say, I'm done. Coming the next day, central bank raises rates to 5%. This looks pretty good now. You're glad you've locked in 4%. Otherwise, today, you would probably get something close to 5%. Okay? So this transaction, this swap, has value, and it changes on a day-to-day basis. Okay? But if you rewrite this on day one, so on day one or day 0, however you want to call it, PV is 0, and that defines the par swap rate. Okay, it's just a reorganizing of numbers. Okay, this is overkill. For the purposes of questions on exams, just understand the mechanics of a swap, understand the hedging benefits that it offers, and understand the use cases. Okay? You can safely assume you won't be asked to write down the formula for a fixed leg and a floating leg and solve for the par swap rate. You would on a more advanced course, definitely, but not in this course. Any questions on any of that? Okay, so I want to talk about the idea of bootstrapping. Okay, so I've told you these zero coupon bonds, Z, they just exist. They're out there. You observe them somehow. Okay, now we're going to talk about where they come from. All right? And this is a pricing equation that you should know. I've already mentioned that. It prices a fixed coupon bond. It turns out the most actively traded instrument in the fixed income market are these fixed coupon bonds. Okay? Risk-free fixed coupon bonds. And we need to be very clear on this today because later on, we're going to relax that definition. Okay, but right now, risk-free coupon bonds. That means a bond where you're guaranteed to get this coupon C out till the end and to get your money back with the redemption at the end. Okay? No chance of the company filing for bankruptcy. It's the government. Okay? Or even if it's not the government, we're living in a world where this default just can't happen. Okay? So I told you that this is the pricing formula, which it is. And I told you once you have Z, you can price P, which you can. But in fact, what actually happens is the opposite. You observe P in the market because there's just so many of them. Okay? There's an auction for US government bonds every other week. Okay? So you get these Ps, and what you're trying to do is extract the Z. Right? That's what actually happens. And the process to go that way is the bootstrapping process. So let's say we had, that's T0 today, 1, 2, going out to 30 bonds. Tn goes out to 30. For each bond, you can write down an expression. Each bond has its own yield to maturity. Okay, maybe I need to write this better. This needs to be e to the minus yi ti. E to the minus yi tn. Okay? The point is that each ti has an associated yi. Agree? Each bond has its own yield to maturity. And what you're trying to do is extract these guys. Okay? But extract them in a way where you write each one in terms of its yield to maturity. It doesn't matter. You can go from one to the other. It's just an exponential. Okay. I've chosen here to represent the yield to maturity as a continuously compounded interest rate. You could very easily, there's no right or wrong, decide, I want to use that formulation. Okay. Remember, right on day one, we said that there can be different rates of interest in the market, but they all have to give you the same level of return on your investment. In other words, if you invest $100 in a bank account that pays you e to the RT, or you invest in a bank account that pays you some interest rate, but every year, at the end of the year, you have to have the same return. Okay? That's allowed. There's no arbitrage. So that's why you can choose which unit you want to work in. Continuously compounded, annually compounded, it doesn't matter. Just pick one. Okay? But once you've picked one, you can go from Y to Z easily. Okay? It's just all you need to know is the tenor or the maturity of the bond. Okay, so what is the algorithm? What is the algorithm? Maybe the easiest thing to do is, I'm not going to cover this. This is not as interesting as this. This is the one we really want to focus on. I think the notes might do a better job. Can you see that? All right, I'll go through this. It looks messy, but it's because the expressions have a lot of symbols, right? It's really not complicated. I'm going to represent it T1, T2, T3. These are our bonds. In between, we have these little dates. What are these dates? Coupon dates. Okay? Let's make it a little bit more easy to follow. I'm going to assume that these bonds pay coupons quarterly. Okay? Right? So T1 is the first bond. T2 is the second bond. T3 is the third bond. What we're trying to do is from T1, from P, extract all of these Z's. Okay? Okay, this is just the big picture. From P, T2, you extract right? Now remember, T2 bond the T2 maturing bond still has coupons during this period. Okay, but you're going to discount those coupons using values you've already extracted when you bootstrapped T1. Okay? Then you come to do T3. You extract these values, but you've already got all of those bond prices. Okay, so each time, with each iteration, each new bond, you're extracting some new information. Okay, that's exactly what bootstrapping is. Right? That's the idea. That's what we're doing. Very similar to when we were bootstrapping forward vol. In fact, identical in terms of philosophy. What did we do with volatility? We assumed you had a one-year expiry option, a 2-year expiry, a 3-year expiry. From the 1-year expiry, we extracted 1-year vol. From the 2-year expiry, we had the option price for a 2-year option, but we only extracted the forward vol from 1 to 2 years. Then we introduced the 3-year option. We extracted forward vol from 2 to 3 years. Okay, you're extracting information as you go along. That's all we're doing here. Okay, so this is, well, that's the price. We've already seen that. This is just a rewrite. Okay, just rearranging terms. This expression corresponds to a case where we have, let's call that tk minus 1, tk. So this expression is trying to extract these bonds from this price. Okay, now you need to write it. And the first line is just a summation of all the coupons and the redemption at the end. But I'm going to split it into two. Okay, I'm going to split it into all the coupons, nk, which come before time tk, and all the coupons and the redemption which come after tk. Okay? The idea is we've already done these. So you can rewrite this using that expression on top. You know, just follow the logic, but you can rewrite it in terms of the tk bond. Okay? And the coupon for the tk bond. In other words, you know everything here. You've already extracted that information. All you're left with are these. Okay? And you know this. That's the price you observe in the market. Okay, that's the algorithm. That's it. Now you need to go one other step because you're going to write this term like this. Okay? And the only thing you don't know is yk plus 1. So again, this is just a root finding problem. Okay? Solve some value. That's what you're trying to do. Okay, you know the right-hand side, you just need to extract yk. That's the bootstrapping process. At the end of this, what are you going to have? At the end of this, you're going to have a list of ti and the associated yi. Agree? And you can easily go from those quantities to z of ti, which is e to the minus yi, or 1 over 1 plus y. That's the way you've chosen to do it. But that's how you store the object. Okay, that's the yield curve. This is a big topic in interest rate derivatives. Even now, you'd think people have got this locked down, but there's always numerical subtleties, some convergence problems. Comes up time and time again. Okay? But this is a 101 of bootstrapping. So you look at the market, what do you have in the market? Bond prices. What do you do with the bond prices? You rank them all, and you start extracting zero coupon bond prices through this process of bootstrapping. Right? Bear in mind, we are not saying that all of these bond prices are the same. We're saying the yield to maturity is the same. The bond prices will be different because bond prices depend on yield to maturity multiplied by time to maturity. Right? So even though they have the same yield to maturity, they have a different time to maturity. It's an important point. And in fact, I don't want to go this a step further, but I'll just mention it. The swap market, interest rate swaps, is even bigger than the bond market. Okay? So really what we end up doing is extracting these zero coupon bonds from swap prices. Right? And it's not difficult to see because it's just a very complicated function of all these z's. So you can do the same logic. Okay? You have a 1-year swap, you extract all the zero coupon bonds to 1 year. 2-year swap, same idea. You've done everything for 1 year, now you just need to extract the zero coupon bonds from 1 year to 2 year. Look in the market, you'll get a 3-year swap, 4-year swap, goes out to 30 years. Okay? You do the algorithm, you've got your zero curve. So if you follow this, then that's good. This is quite an advanced topic. You know, I debated whether this should be in the course, but I'm glad I put it in because it is an important topic. Any questions on that? Okay, bootstrapping. So in terms of this, okay, what do you need to know for the exam? That's what you're all thinking, right? You have to know this. This is accounting, right? That's the price of a bond. You should recognize that you can split up the cash flows in this way and extract one piece at a time. Okay? If you can follow this logic, it's probably good enough. Okay? I don't think it would even be reasonable to ask you to write any pseudocode around this at this point. Okay, there's no problem set for weeks 12 or 13, but had there been, this would have been the standard question, right? Write down some pseudocode or write down actual code to extract the values. And I would have given you a table of bond prices. I would have said 1-year bond, 2-year bond, 3-year bond, here are the prices, give me the zero curve. But since you haven't had that experience, I think it would be unfair to ask you to write down pseudocode. Okay, but this is not pseudocode, this is maths, which would lead to the bootstrapping algorithm. So I think you should be comfortable with what I've highlighted in red. Okay, I think that's probably enough for swaps and zero curve bootstrapping. Okay, don't worry about bootstrapping from swaps. That's beyond the scope of this course. Right, any questions? If there are none, then let's take a short break. When we come back, we'll spend probably about half an hour, at most 40 minutes, talking about credit. And then what I want to do is I want to go over the midterm. Okay? So we'll go over the midterm questions and think of if you have any questions, either on today's material, previous material, on the exam, any questions, we can go over them. Okay? So let's come back in 10 minutes, 9 minutes, 8 o'clock. All right, credit risk is the last topic. And it's going to be relatively short because other than introduce some basic economics and just two of the common, probably most common credit derivative products, there's not much more really we have time to cover. So we're now in a world where we need to think about the possibility of a company going bankrupt. Okay, so everything we did until now didn't really touch upon bankruptcy. Okay, because imagine this scenario. Somebody writes an option, you're a bank, you write an option, client goes away, comes back in a year, needs to exercise their option, but the bank's gone. The bank was Lehman Brothers on the 1st of January 2008, and the option expired 1st of January 2010, right? We kind of ignored that effect. We assumed that you would always make good on any obligations. Credit risk is precisely the allowance for not being able to do that. Okay? Okay, so we're going to have to introduce a little bit of maths. For any statisticians, you would have maybe come across something called the Poisson distribution. Okay? Has anybody come across this distribution? Poisson distribution? Okay, some of you. Discrete distribution. It measures the number of times an event can occur in a time interval. Okay? That's what it is. So if you have a random variable, and I've seen this usually being applied to the number of phone calls that comes into a call center in a 1 hour period. Okay? It's non-negative, and the value can in theory be 0 or all the way up to infinity. Okay? Although the probability of infinity just diminishes. But in its essence, the random variable can take on a discrete number of values. Right? X equals 0, 1, 2, etc. And the probability of that number of events, so remember, we're talking about number of events within a time interval. The number of events is given by this expression, where lambda, capital lambda, is just the expected number of events. Okay? That's the specification of a model. Like in a Gaussian, you specify the mean and variance. For a Poisson distribution, you specify the expected number of events within that interval. Okay? And what we're going to be focusing on is the first event. Okay? What we're trying to do is model the arrival of the first default event. Okay, so the event in our case is the corporate default, bankruptcy. Okay? Now the only interesting number is x equals 0 or x equals 1. Okay? A company can't default more than once. So what we do is we set this lambda to be some small lambda times t. So small lambda is called the intensity. Think of it as the number of events per unit time. Okay? And t is just your time horizon. Okay? Maybe you're interested in a time horizon of 1 year or 2 years, whatever it is. T is going to turn out to be a variable, but whatever it is, that's your time horizon. And we're going to focus on the probability of x equals 0. Okay? X equals 0 means no events in this time horizon. No events means no defaults. Okay? So the probability of x equals 0 is the probability of no defaults, which is the probability that the counterparty is still alive. Okay? That's called the survival probability. And it's just an application okay, that's the survival probability. It's just an application of this distribution. Right? Setting k equals 0. 0 factorial is 1. Lambda to the 0 is 1. And what you're left with is e to the minus lambda. And we've already said capital lambda is little lambda times t. Okay? So QT, survival probability, is just the probability that default doesn't occur. Now I'm also going to introduce another, a related random variable. I'm going to call it tau. And tau is the default time. Okay? Tau is the the time of default. And tau, of course, can only be greater than or equal to 0. Okay? Otherwise, if it's negative, it means the company's defaulted. But tau can only go forward in time. So this survival probability, Q of little t, surviving up until time little t, is the same as the probability of tau, the default time, being greater than t. Right? Because we're saying that default can occur. It will occur at some point. It might occur at time infinity, but it will occur at some point. So the survival probability is just the probability that it doesn't occur within your time 0 to t. Okay, you do a little bit of rearranging. If the probability of greater than t is this, the probability of less than t is 1 minus. Okay? And then we work out the probability density function, okay, which you all know how to do. The PDF is just d by dt of the cumulative distribution function. Okay? It's a very handy formula. If you're ever stuck and you're trying to work out the probability density function, it's usually much easier to work out the cumulative distribution function and then differentiate it. So this turns out to be the PDF of default. And what does this look like? If you just plot it with time t, at 0, the value is, lambda. Okay? And it just decays. Okay? It doesn't go negative. Sorry, that's really badly drawn. But it decays to 0. That's just the PDF. That's what it looks like. If you're interested in default in any future period, you just integrate that over the period. That's it. All right, so that's our model for default. The important expression that we will use is really this one here. Okay, the survival probability. Okay, so lambda is something you might be able to estimate. Okay, it's the number of defaults per year. You can look at companies, see how long it takes them to default, work out an average time to default, come up with lambda somehow. Right? But let's say we've got it. That's the intensity. So now what I want to do, and for this you should jump into the notes because there's a little bit more details than I put on the slides. Okay, so we have Z. Z are risk-free bonds. Okay, so here's the background. You're a company, you need to raise capital. You're saying, I need you to make me a loan and I'll pay you back in a year. Okay, it's like a zero coupon bond type interest. And I look at you and you're a very safe company and you think, okay, you're as safe as the US government. Okay, and if the US government charges 4%, I'll probably charge you close to 4%. Another company comes along, they're a startup. Okay, they don't know what they're doing yet. They need money for a year. But who knows if their idea is any good? Who knows if they'll be able to execute on it? And they need to borrow for a year. What would you lend to them at? A little bit more? A lot more? The point is you won't lend at 4%. Okay? You'd lend them a lot more. Maybe you decide 5%, no, it's not too much. You look at your business model, I don't believe it. 10%, 20%, you think, okay, it's worth the risk. There's a risk here, but I'm getting an enhanced rate. So what we observe in the market, we have these risk-free zero coupon bonds, and we've talked about them extensively, right? What we just extracted from the market in terms of bootstrapping was the risk-free zero coupon bond curve. I'm going to introduce B of t as the corresponding zero coupon bonds, but for a counterparty that is risky, right? That might default. Now we can do what we've done before, introduce y hat, and I'm going to call that the risk-free yield to maturity. Remember we did that? We just took the bond price to extract the yield to maturity. Because it's a risk-free bond, it's a risk-free yield to maturity. And I can do the same with this bond. Again, assume this zero coupon bond B also exists, right? In the same way, we could extract them from corporate bonds. Yeah? US government issues bonds, but other corporate companies that need to raise capital also issue bonds. Those companies can become distressed. It's reflected in their bond price. So it will be reflected in the zero coupon, the risky zero coupon bond prices B. Okay, so same thing going on. But I'm going to call y hat tilde as the risky yield to maturity. Rewrite it as this, where I'm just, subtracting y hat, adding y hat. This term just goes to z. That's what we've had before. And what you notice is that the risky bond looks like the risk-free bond times something. Okay? Just go through the maths, it looks like the risk-free bond times something. And this something resembles a lot like Q of t. Okay? Which makes kind of logical sense. You're saying that the price of my risky bond is just the risk-free bond times the probability that the counterparty is still alive. Okay? And this term S here turns out to be the lambda. Okay? The intensity. So if lambda is 0, what does that mean? The number of events per unit time is 0. That means it doesn't default, no events. Which means Q is 1, which means your risky bond is as good as your risk-free bond. On the other hand, if lambda is a big number, large number of defaults expected per unit time, this becomes a very small number, dampening effect. The risky bond is worth a lot less than the risk-free bond. Okay? So you might be able to buy a government bond at $95 and get back 100 at the end. So you've made $5. There's no way you would buy a risky bond at 95. You might buy it at 90, or if you're really worried, less than that. Okay? But your smaller investment, you still get back 100. Okay? That adjustment is in this survival probability. Okay, you see that? So that's the idea of a risky bond. And this S, the reason it's called S is because it's a spread. Okay? I'm going to talk about that a little bit more, but in this context, you can think of it as lambda. Okay? But it's really going to turn out to be a spread. Spread just means an additional rate over the rate of interest. Okay? Because that's exactly what it is. It's basically, if you look through the logic, the yield to maturity, the way we've represented it here, of the risky bond, is the yield to maturity of the risk-free bond plus some. Okay, so you get additional yield to maturity. Okay, now, what about risk-neutral framework? For the risky bond, for the risk-free bond, this guy was just 1, right? Payoff is 1. That's what it means, risk-free. I'm guaranteed. I'm getting 1 at expiry, at maturity. And then I just need to discount it. For a risky bond, I'm introducing tau, which is the default time. You only get a payoff. This is the indicator function, right? It's come up a few times, but the indicator function is either 1 or 0. It's 1 if this condition is true, which is basically what we're saying is you get your money back, your $1, if the default time is after capital T. In other words, we get your dollar back as long as there's no default event. Right? That's the expression. You get your money back as long as there's no default event. And risk-neutral valuation would say that that's the expectation. And this looks very similar to what we have up here. Okay? What's the assumption? To go from here to up here, what have I assumed? How have I gone from there to there? There are two random variables here, right? In general. R could be random, and tau could be random. I haven't said anything about whether R is random or not, but in general, they could be. If I assume they're independent, I can split them out into two. And then the first term will be what we've already seen, the zero coupon bond. And the second term is exactly the definition of a survival probability. Okay? So you get back what we had up there if they're independent. Now you could argue that companies are more likely to default. If interest rates go up, their obligations go up, they get distressed. So yeah, there's a case. But more likely you could say companies default because of mismanagement within the company, because their business plan's no good, because they go out of fashion, whatever, unrelated to interest rates. So either way, there's a case. Right? It's not so clear-cut. Okay? But remember, correlation is always in the background. Okay? And you all understand the dangers of correlation if you misunderstand it or misrepresent it. So you can basically go from one to the other if you make an assumption of no correlation. Okay, now there's another issue in terms of how default actually works. Okay, so when a company goes into administration, Chapter 11 bankruptcy, and declares insolvency, what tends to happen is lawyers get involved, they get all the assets of the company together, there's a fire sale, they sell everything. Whatever they raise, they use to pay back the people they owe. Okay? So in other words, if you hold a bond from a company and it goes default, it's very rare you get back zero. Okay? You get something back. And that something we're going to call R. It's the recovery. Okay? And R is something between 0 and 1. Either you get 100% back, which is unlikely, or you get 0, which is also unlikely. Okay? You'll get something back. So we can improve this. Okay? This assumes no recovery. Okay? It assumes you don't get anything back. Default occurs, you get 0. No default, you get 1. So in the presence of recovery, we can just update it to this. Now we're saying if default doesn't occur, tau is greater than 1, tau is greater than capital T, you get back 1. If tau is less than capital T, you get back R. Right? That's the payoff. And we still have this kind of factor. So what I'm doing here now is coming up with a better representation of the expression for a risky zero coupon bond. Okay? What I had previously was a first stab, but we can do better. Now I'm going to assume they're independent, so I split out the two expectations, and everything along here is what we had before. This is just Z. Right? It's what we had before. I want to concentrate on the right-hand side. And it's just a little bit of algebra. But if you take the expectation inside, because R, 1 minus R are constants, and you have an indicator function, the expectation of an indicator is the probability of that event happening. Okay? It's one of the rules of probability theory. And we know that the probability associated with tau being greater than T is just a survival probability. Okay? We've seen that. It's just this. The rest of it is just mathematical manipulation, and all we need is the approximation that e to the x is equal to 1 plus x for small x. Okay? That's all I'm using. So just follow it in your own time. E to the minus lambda, 1 minus r, multiply stuff out, put it together, refactor it all using the same assumption, This is what you get. Okay? Our S went from lambda to this expression. So I would want you to know this. This is the credit spread. This is the spread that you get over the risk-free rate to take on the risk of default. Okay? But look at it closely. What it says is that if R equals 1, let's think about that. If R equals 1, the credit spread is 0. If R is 1, the risk-free bond, this term will disappear, and you're just left with a Z. Okay? That means that even though you've had a default, you've recovered everything. So you don't care about default. There's no additional risk here. Okay? On the other hand, if R is 0, then that term really gets maximized. Okay? So there's two things happening. There's the default event, and there's the recovery on default. And it's the combination of the two that you really care about. Okay? If R is 0, you don't care about default. S goes to 0. Okay, so it's not just the occurrence of default, it's the severity of the default. Okay? In an event of default, how much can you recover? Now, what is R? I've just thrown it as a symbol. Nobody knows what it is. Okay? It's one of the parameters, and usually you have to wait until the end of the arbitration, and it goes to the courts, etc., etc. People have done a lot of studies in the market. The typical value of R to use is 40%. I don't know where it came from, but that's what a lot of studies have shown. Most models just hard code a value of R equals 40%. Okay? It's better than nothing, right? So what have we done here? Let's take a step back. We've kind of gone full circle, right? On day one, we introduced the idea of an interest rate, and we said that this money market account is needed for us to price derivatives, and it's a good discount factor. Later on, we got more complicated, we got more advanced, and we said, this discount factor, this rate, we can make it stochastic. It's not really random. It's not really deterministic. So we enhanced our model. Okay? Now we've gone a step further. We said, well, actually, we've got a default in the picture. So we introduce S. Okay? It's deterministic. What we've done really is introduce a new parameter into our model. Okay? Same way as we introduced R on day one. We can go a step further. We're not going to do it, but that's what credit modeling is all about, and say, well, S isn't really deterministic, right? It's also stochastic. COVID, all these spreads spike up because nobody knows who's defaulting. Right? Great financial crisis, everything spikes up. Economy picks up, it all comes back down again. That's the cycle. Okay? That's what quants do. Next step would be to make S into a variable. Introduce some dynamics around it. But we've already improved things. Okay? It would be nice to introduce dynamics, but just adding this term in, even as a deterministic term, you're already doing better. Okay? It's better than ignoring the risk of default entirely. Okay? It's all about how far do you want to go? How advanced do you want your model to be? Okay, any questions on this? So for this part, I'd say no, the exponential distribution. Sorry, I should have mentioned that. This distribution, I introduced the Poisson distribution, but tau follows the exponential distribution. And the exponential distribution is closely tied with the Poisson distribution. The exponential distribution is precisely a study of the Poisson distribution for x equals 0 or 1. Okay? Because we're only thinking about the first event. And we're talking about the time until the first event. Okay, maybe that's the right way of putting it. We start off with a Poisson distribution where we only care about the first event, and we say, well, what's the time until that first event occurs? And that time can be 0 if it happens tomorrow or immediately, or it could be infinite if it never comes. But that tau, that time, is what measures our default event. Okay, so I'd be comfortable with the idea of an exponential distribution. Actually, I think you've seen it before. The problem set on Monte Carlo probably had you generating random numbers from an exponential distribution. I'm pretty sure about that. There was one exercise somewhere where you used acceptance, rejection, had a, or maybe it was a lecture. I can't remember where I put it. I created that a few years ago. It was in the lecture, right? I think in the homework you did the Gaussian. Is that right? You had to use acceptance, rejection to generate Gaussian random variables. Anyway, but you should be comfortable with the distribution and the idea of a credit spread. Okay? And I'm going to talk about one other product. So there are two, what I call big products in credit world. One is the bond, the risky bond. The other one is called the credit default swap. Okay? And this is a big market. And there's nothing to it, really. Okay? The idea of a credit default swap you've all already seen. It's like any insurance policy. All right? So take your car insurance. How does it work? You go out, you take a policy, you pay premium every month. Okay? And you keep paying premium, let's say for a year. At the end of the year, well, you've just paid a lot of money and nothing's happened. Okay? But the payout comes if you crash your car. Because the moment you crash your car, you get a payout. Right? Credit default swap is basically the same thing. There are two legs, something called a premium leg. Okay? You go to a bank, Morgan Stanley or JP Morgan, and you say, I need a credit default swap on company XYZ. I'm worried that they're going to default. What Morgan Stanley says to you is, okay, pay me a premium every month. And as soon as the company defaults, if it ever does default, I'll pay out. Okay, that's the market. That's the trade. So the protection leg, the two legs, there's a premium leg and the protection leg. So the protection leg is just that mathematical expression. Okay. Remember, Q is a survival probability of tau being greater than little t. But then you can take the 1 minus and take dq, that's the intensity of default. So dq is the PDF of default. Okay? So you're integrating from the TS is the start date of the policy, TE is the end date of the policy. That integral is the probability that you have a default at some point. Okay? And if there's a default, this is just a discount factor. If there's a default, you pay out 1 minus R. Why 1 minus R? Perfect. Yeah, because the idea is that if you have, think about who would take on this policy. Somebody who's bought a bond on company XYZ, bond's paying out, great, but they're worried that they might default. So you go to a bank and you say, can I get an insurance policy? But I only need you to pay me 1 minus R, because I'm going to get R back from the company, in theory, right? You could say, just give me back the whole 100, but then, more premium, more payout, more premium, right? Anyway, you can simplify this, discretize it. It's not important. The idea is I want you to understand the intuition, right? The protection leg is basically just like a car insurance. At some point, there's a default. If there is, you get a payout. And the payout is, in your car policy, this would be the value of the car. Here, it's 1 minus R, right? It's the value of the bond. The other leg is a little bit more complicated. You've got regular premium payments. Going on. Regular premium payments. And we're just going to talk about premium I, which is for some period, Ti to Ti plus 1. Okay? Let's focus on 1. Now what can happen? Either default can be here. Okay, if default happens after time let's call this ti minus 1, ti. If default happens after ti, well, you still end up paying that premium, right? Usually you stop paying premium at the point of default, right? But here in this case, if the default happens beyond ti, you don't pay anything. You still pay the premium. If it happens here, then you don't pay any premium, right? You don't get to live long enough that you need to pay a premium for that period because it's the default happened before. So here it's 0. Here you pay full premium. If there's a default at some point in this period, you usually pay a pro rata premium. Okay, so if it's default happens halfway through the period, you pay half the premium. That's usually the way it works. That's what this term here is saying. Okay? For one premium PI, that's the expression. You can go through it in your own time. It's unlikely that these expressions will come up in an exam. Okay? I'm showing it here because we've done enough for you to understand it and see it. But really the first term is you survive up until time ti. Okay? So if you survive up until time ti, you are going to pay the premium. If you default between ti minus 1 and t, you pay this pro rata value. And that's it. Those are two legs. Okay? So hedge funds, different investors, speculators, what they do is they go to the market, they look for distressed companies, and they go to a bank and they say, I want to take an insurance policy. Sure, I'll pay you the premium, but they know a big payout's going to come if the company defaults. Similarly, you could play the other game. You could look at a company, looks like they're having a hard time, but you believe they're going to make it, and you say, you know what, I'll sell insurance on this company. I'll collect the coupons. It's free money because I'm never going to pay out. So a lot of hedge funds, a lot of strategies do this. They find companies and they just sell insurance policies and they collect the coupons and they make a lot of money until the correlations all go to 1 and they all go bankrupt and they pay out on all of them and then the hedge fund goes bankrupt. Okay? So again, correlation comes up in the picture. And by the way, this insurance policy, so you take it out today, you look at company XYZ, you think, okay, they look like they might be struggling. I'll take out an insurance policy. I'll pay, 5% premium. A week later, there's news, okay, this company really is distressed. Okay, really distressed. Now insurance premium costs $10, 10%. Your policy now has value. Somebody will be happy to take it off your hands for 5%. Okay? And they'll pay you for it handsomely. So these contracts, like the interest rate swaps, the value fluctuates with time. Okay? So another strategy that a lot of hedge funds take is they just go in because they think the perceived risk is going to go up. There may not be a default, but they buy the interest rate, the credit default swap, which requires them to pay premium 5%, wait for the company to really get distressed, and then they sell the policy at a profit. Okay, that's another strategy. Okay, that's all there is. That's credit risk. That's all we're going to see in this course. Bonds, credit default swaps, the idea of recovery, credit spread, risky versus risk-free bonds, that's enough. Okay, in terms of mathematics, the exponential distribution and its association with the Poisson distribution. Right, so what do people want to do now? Do you want to take a break or should we just go straight into the midterm? Break? All right, let's take a 8-minute break. Let's be back at 8:45. Okay, I don't think we need too long to go over the questions. We won't be releasing individual scores, but I did want to go through the paper to give you an idea of how the questions should have been tackled, give you a sense of where you need to do a bit more work. I think it was a mildly challenging, I would say. In terms of the scores, I think they were roughly where I was expecting them to be. Okay. Okay, question one. Question one, ST is a random asset. So it's an investment that grows randomly. Okay, so you've got Brownian motion and you've got some function of time. This is just maths, right? This is just Ito calculus. So ds is ds by dt, dt plus ds by dw, dw plus a half, that's the bit you need to remember, d squared s by dw squared. And this is the Ito term, right? That looks like dt. So the answer is that one. Okay, that's just Ito, that's just maths. Stock is currently trading at $100. Traders can borrow or lend at 4% with annual compounding. We ignore that there are transaction costs, ignore liquidity issues. And then you see that someone in the market is quoting a 1-year forward price of 101. Okay? And the question asks you, which of these portfolios can generate a risk-free profit? So the first thing you need to think about is, well, what do you think is the forward price? And this is one of those things you have to be able to derive or remember, right? But you should be able to derive it. The forward price is just the current price times the interest rate. Okay, remember how you synthesize a forward. You buy it today. To buy it, you borrow, which means that you need to repay interest at the end. So you sell it on a forward basis at precisely your interest costs, right? So you recognize that the forward is around 104. Okay? So the market's quoting it too cheap. Usually when something's too cheap, you buy it. Okay? So if you're buying this forward contract, it means eventually you're going to have to take on the stock. Okay? So you need to be short the stock. So you buy the forward contract, you short the stock. If you do that, you basically when you short the stock, you get $100, you put it in the bank, it grows to 104. Okay, use 104 to buy the stock on a forward basis for 101, you lock in $3 profit. Okay, that's the rationale. Okay, so this question was more on understanding arbitrage pricing. Okay, so you have an asset trading at $100, and you have a straddle. And a straddle is something that has a payoff, longer call, longer put. That's the straddle. And this is trading at $20. Okay? And the strangle, which is a 10-wide strangle, has a payoff something like that. Okay? So you notice immediately that the straddle has to be more valuable. Okay? Because it pays off more often. Strangle may not pay off. Right? If you're here, strangle doesn't pay off, but straddle pays off. So immediately you know that it can't be this. In fact, it can't even be 20. Right? So it's got to be less than 20. Now, can it ever be 0? Can't be 0, because you've got to pay off. So the only really credible number is 15. Okay? All right, this one. Okay, so this is a question shows how well you understand the log normal distribution. This is a very important question. Okay? This is this comes up every time you do a derivation for a pricing formula. Right? So you have a log normal asset, starts off at 100, you're given R, you're given sigma, and it's driven by Brownian motion, and the question is asking you to estimate the probability of ST being greater than K. Okay, K is 110. So you need to know that ST is S0 e to the r minus a half sigma squared t, right? Plus sigma wt, but you're better off writing it as sigma root t times z, okay? Where z is normal. And then just rewrite it, okay? You'll get something like p of z greater than, I don't remember if it's 0.12 or negative 0.12, whatever, whichever one, okay? But you need to write it in terms of the cumulative distribution function, which is 1 minus. So the probability of z being greater than 0.12 is the same as the probability of z being less than minus 0.12, right? It's the symmetry of the normal distribution. So I don't know, it's one of these two. I can't remember the numbers, but that's the idea. Okay, a lot of you got this far, but then you forgot that you need to revert it, right? You need to be very clear how that relates to the cumulative distribution function. Okay? If you do your Black-Scholes derivation, that comes up as well. You have to account for the sign. Okay, implied volatility for an option. So you're given implied volatilities on an asset for expiries going out 1 year, 2 year, 3 year, out to 5 year. And this is a bootstrapping question. The question asks you to estimate the forward volatility for the future period 2 to 3. Okay? So you know the volatility for 2 years, you know the volatility for 3 years. And what you're trying to extract is the forward volatility between 2 and 3 years. Okay? And if you follow, it was an open book, so you all had the formula. Okay? Sigma 2 times T2, sorry, sigma 2 squared times T2, plus, let me call it sigma bar as the forward volatility, times T2 minus T1, sorry, squared, is equal to sigma 3 squared times T3, right? And you need to solve for that guy. You've got all the numbers except sigma bar, right? And I think the number was 8.7. Okay, just punching numbers in the calculator. Now, for example, if something like this came up in an exam, I would be less looking at 8.7 and more looking at the formula you're using, okay, because you won't have your notes. So you're forgiven in that case for not punching in numbers correctly. In fact, you probably won't even be asked for the number. You'll be asked for the expression, okay? Same up here. I'll be paying close attention to whether you've got your negatives right. Okay? The number is not so important. The methodology and the recognition of the symmetry of the distribution, that's what's important. Okay, so this is a continuation. Now we're saying that all of these volatilities have been validated, 1, 2, 3, and 4. And the question is asking you for a lower bound on the 5-year implied volatility. Okay, so let's take a step back. Say I hadn't given you any of these top ones, okay? Say you didn't have, there was no table with 1, 2, 3, 4. You just had 5-year volatility. What's a lower bound on the 5-year volatility in the absence of any information? 0. Yeah? Volatility can't be negative. But this changes things, okay? Because now we're saying that there is actually a lower bound because you have to ensure that the forward volatility doesn't become 0. Okay, you need to ensure that 4 to 5-year forward volatility stays 0. If you plug in 1%, okay, and you work out forward volatility, you'll see it's 0, it's negative. So what you need to ensure is forward volatility stays positive. And how would we do this? We'd say that we know that sigma 5 squared times T5 plus forward volatility T5 minus T4 is equal to sigma 4 squared times T4. Okay, that's the equality. We're saying that this has to be greater than or equal to 0. Okay, so if we rewrite this as, this is just 1. we want to work out what this is, right? That's the value we're after. And this has to be greater than or equal to 0. So you can rewrite it as sigma 5 squared T5 sigma 4 squared T4 minus sigma 5 squared T5 has to be greater than or equal to 0. You know this, you know this, you know this. That's the value you need to extract. Okay? I think the answer was 11.63. If you punch in the numbers, that's what it gets. So you see 10 is no good. Looking at that table, you wouldn't know that 10 looks perfectly reasonable. But it turns out that if you saw that quoted in the market, your algorithm would pick it up straight away. And you'd see that this is priced badly because 4-year into 5-year volatility is negative. Okay? Which means the 4-year, relative to the 5-year, the 4-year is priced too highly. Okay? It needs to come down a bit. Or the 5-year needs to go up a bit. So there's an arbitrage opportunity here. You'd buy the 5-year option and sell the 4-year option somehow because you know those prices have to move in that direction. Okay? To eliminate the negative forward volatility. Okay, this, if you followed the demo that I did on Excel a few weeks ago, this should have been, basically, I think we did exactly the same example. Right? We took on the role of a trader who sold a call option. Okay, so that's what the question says. You're a trader, you sell a 1-year expiry call option with a strike of 90. The underlying stock is 100 today. And then the stock price does something. And all you know is that at expiry, it comes back to 100. Okay, with a strike of 90. Right, so you've sold this option and now you're delta hedging it. I would urge you to go back to the demo and just look through all the details there. Okay? So as part of the strategy, what do you need to do on day one? Well, what's the delta of a call option? Delta of a call option is positive. Okay? You've sold the call option, so you've got negative delta. To delta hedge, you need positive delta. How do you get positive delta? You buy the stock. That's one way of thinking of it. Okay? The other way of thinking of it is that you've sold a call option. That means the client has the right to buy the asset. So one day they may come to you asking to buy the asset, at which point you need to have it ready to give them. So you need to buy an asset. Okay? You never need to be short. Okay? Worst case scenario, your position will be 0, but you never need to be short. And at time t0, because you don't quite know what's going to happen, you end up having to buy some of the asset. Okay? So the answer is you buy the stock. Okay, question 2 says, what happens at time expiry? And I realize this is a badly posed question. But I was fair to you. So what I was asking is that what happens at time t? Okay? At time t, the stock's at 100. What's the client going to do? They're going to exercise. So they're going to come to you asking to buy the stock. You better have it ready at that point. So the answer I was looking for is that you need to be long 1 unit of the stock. But then I thought, well, that's not actually fair because you're going to sell the stock. So you end up with 0. Okay? What I really meant to say is that what would your position be just before T? Okay? Then that would have been the right answer. But I gave you points for either of those. Sorry, not long. This one, 0. Because I thought, okay, you need to be long the stock, but then the client's going to come, you're going to sell it, so you won't have it anymore. As I said, I could have worded that question better, but I didn't penalize you for that. Okay, theta and gamma. Okay, so we talked about the theta and gamma of a call option in the lectures. We had the payoff the profiles, the charts. So what is the gamma of a call option? Just a call option on its own. 1 unit of call option, positive gamma, right? Theta, negative. We showed this relationship where They're always offsetting, right? Because they need to be constrained. We saw the case of the binary call option where, depending on where you are, the binary could have positive gamma or negative gamma. But in each case, the theta also reverted. Okay, so gamma and theta are always opposite signs. That's the first thing to remember. Now, you've said already that a call option has positive gamma, but you're short the call. So you have negative gamma. Okay, so you have negative gamma, positive theta. Right? Last one. So what is the correct statement? What happens if the volatility suddenly increases during the life of the trade? Right now, the whole Black-Scholes framework assumes volatility stays constant. Okay, so it's baked in, that assumption. But that doesn't mean the market's going to behave according to some model that somebody came up with, right? You look in the market, the volatility spikes. What happens? This is a case of a parameter changing value when you don't expect it. Okay, when that happens, one party always makes money, the other party loses money. It's a zero-sum game. Okay, now how do you know what side you sit on? What's the vega of the option? Call option has positive vega. You're short the options. You have negative vega. So if the vol goes up, you lose money. That's one way of looking at it. Okay, it's valid. The other way is to say you sold this option at some value of volatility. Did I give you the level of volatility? No, I didn't. Well, whatever it was, 20%. You sold it assuming volatility is 20%. If it turns out volatility is actually a lot higher, what does that mean? It means you sold it too cheap. Okay? You sold something at 20% when you should have sold it at whatever, 30%. You sold it too cheap, which means it's going to catch up with you at some point and you'll lose money because of that. All right? So the trader loses money in this case. All right, two models for X. Now you should recognize, well, the first one is standard log normal. There's nothing there, right? All I've done is remove the drift, but that's okay. Okay, this is definitely log normal. If you look at this, you can rewrite this as dxt sigma as some function of time, xt dwt. It's a deterministic function of time. So it's still log normal. Okay? I feel like I'm going to be on Facebook or something at the end of this. So many cameras pointing at me. Okay, so they're both log normal models. Okay, you should recognize that. They're not Gaussian. I think some people put Gaussian. Maybe people got confused because they saw Brownian motion. Brownian motion is not the model. Brownian motion is our source of randomness. And yes, of course, that's Gaussian. The model itself is log normal, right? The model for X is log normal. It would have been Gaussian if we didn't have the X, because then you're basically saying that X is a linear function of something Gaussian. Okay, so now what is the probability of xt over some time horizon being greater than 2x0? So we're talking about a tail, right? If this is the distribution, this is x0 and this is 2x0, we're saying what is the probability of being in that tail? Okay, and the probability depends on the width of the distribution. Wider distribution, higher probability. So what can you say about model 1? What's happening with the volatility of model 1? You've got an exponential, which is dampening the volatility. Okay. In one case, in the case of 2, the volatility stays the same. In the case of 1, it just dampens. So it's just got less volatility. If it's got less volatility, distribution is going to be narrower. If the distribution is narrower, less weight in the tails. Okay? Doesn't depend on x0. All that x0 does is shift where the distribution is. Okay, last question was worth 3 points. So this is not pseudocode. This is actual code. You could paste this into your interpreter and run it, and it should actually work. Okay? There are 3 bugs code, and you're asked to identify the lines where you think the bugs are. Now, it's a European down and output option, and I think we talked about what the payoff is. It's in the notes. Turns out you don't actually need to know what the payoff is. Okay, the errors are all in the kind of the modeling, in terms of the rationale of the algorithm. So it's Monte Carlo. When you see Monte Carlo, what do you think? 10,000 paths, one after the other. Compute something on every path, and take the average. Okay, that's what Monte Carlo is. So here we go, 10,000 paths. What are we going to do? We're going to simulate S somehow. So on every path, we reset S, and then we update S. Okay? So the first bug is in that line, 22. Because what's the discretization for a log normal distribution? Remember, ds is rs delta t plus sigma s delta dw. And what is this? Normal distribution with variance dt. Okay? Variance dt, which means what do you need here? Square root of dt, right? Because the variance of ax is a squared variance of x. So that's the bug. So you do your Monte Carlo, you simulate S, you update it, you get to the end. At some point you may knock out, those are knockout conditions. On each path you compute V. Okay, and what is the risk-neutral framework? You return the average. Okay, that's why you divide by number of paths. But what am I missing? Discount factor. Okay, so you need e to the minus rt. You could have added it here, but that line's not on one of the options. Okay, so there's a discount factor. Okay, third one is this line here. Okay, why is that a problem? Every single path will be exactly the same. What happens when you seed a random number generator? You reset it. So the way random number, if you've done the homework, you would have noticed this, the way random number generators work, they're not really random. Right? You seed them, and then you get a constant or a certain series of random numbers. You get the same series every time. Okay? It's a pseudo-random number generator. Every time you seed it, you reset it. And what you're doing here is that you're seeding it at the beginning of every path, which means every path is going to look like this one. So you're not really running a Monte Carlo. You're running one path and using it 10,000 times. How do you fix it? Okay, you just move it up outside of the path, outside of the loop. You just seed your random number generator once, and that's it. Okay? You know why we seed a random number generator. If you don't seed it, it'll still work. In fact, if I don't have the seed in there, this code would have been fine. Okay, why do we seed a random number generator? Yeah, you replicate it. So if you're trying to find a bug, last thing you want is you have a bug on one path, but no bug on the next path. You're trying to figure out what's going on. You're stepping through the code, and everything's moving. You seed it to replicate the same paths. Wasn't so bad, was it? Now that you've seen the answers. This is how, as I said, you won't get individual scores. This is how you did. So no surprise, most people are in the middle, 50%. That's typically what I would even see in an exam. There's always a higher tail. I was pleased that a few people actually scored 100%. This is everyone from who took the test, about 200 students. Okay. So if you're wondering about grades, how does it work? Typically, this changes, Subject to interpretation. 10 and above would be an A. Okay, so you'd get like an A plus here, A minus. This is your kind of B range. Yeah, so most people would be in the B range. B minus, B plus. C is probably here somewhere. Okay, so it's not a bad performance because the questions are challenging, right? Given that there's only 45 minutes, and you think on the spot. And be honest, how much did your notes really help you? Right? You have to understand the concept. It'll be the same in the exam. Cheat sheets, notes don't really help you. You need to write down, tell me what you're thinking in the exam. Okay? Whatever you do, do not leave answers blank. Okay? Write down what you think is relevant. You will get points, not on the final answer. You will get points based on all the ideas that you put down. And if you're on the right track, you get points. Okay? Look at the number of points in each part. So maybe I'll tell you a little bit of how the exam is structured. There'll be 4 questions. Okay? Each 25 points. And each has a number of parts, maybe 5 or 6 parts. And they're all related. So each question is kind of one topic. So each part is related. Look at the number of points in each part and answer accordingly. If a question's worth 2 points, chances I'm not looking for that much detail. It's probably just 1 or at most 2 key ideas that you need to mention. If it's 8 points, there's probably 8 things that I'm looking at, right? And you need to hit all of them. But that doesn't mean you need to hit all of them to get the full marks. You just need to hit the points that are relevant. Okay, so 4 questions, 2.5 hours. One thing that I'll mention now, but we'll mention again on the day, you'll get 2 answer booklets. And you'll need to answer questions 1 and 2 in one, and 3 and 4 in the other. Just because that's how the grading is going to be split up. Okay, there are 2 course instructors, so we'll be sharing the grading of the exam papers. Anything else? You'll need calculators. It's closed book, no devices, no cheat sheets. Anything you need will be on the exam paper. Any questions from you? First. Yes. So let me break it down. You all know or should know how to derive the Black-Scholes equation. Okay? That could be a question in itself. Given the Black-Scholes equation, it's just different partial differential terms, right? Different partial derivatives. You should be able to estimate the value of partial derivative using finite differences. And you've seen different. You've forward difference, backward difference, central difference, each with different errors, right? So you should be able to go from partial derivatives into a finite difference representation. That's where you discretize it. And then to go a step further, you should be able to reorganize terms to compute almost like a bootstrap, new terms based off old terms, right? It's an algorithm where you go one layer at a time. So each of those pieces on its own, you should be able to do. Now, will you get one question, one part which says derive the whole equation and write down the PDE and discretize it and give me the thing? Probably not. I mean, that's more than a whole question. But my point is that you break it down. You can derive the PDE. You can write down the numerical representation of the partial derivatives using finite differences. You can rearrange terms and write them in matrix notation if you need to. You can talk about boundary conditions. Okay? Initial conditions and boundary conditions. It's basically just a big linear system, right? A system of linear equations. All those pieces can come up individually, yes, absolutely. So, to give you an idea, what are the type of questions that can come up? And in my mind, they fall into 3 categories. Okay? Number 1, mathematical derivation. Okay, so things like what we saw up here. Okay, this is kind of like a mathematical derivation. You need to know the calculus, you need to be able to write down the formulas. As I said to you, you should be able to derive Black-Scholes call option, or put option, or digital option. Okay? Because on the exam, you won't get a standard call. You'll get something a little bit more complicated. But if you understand exactly how you derive the formula for a call, you have no problem adjusting for a slightly more complicated payoff. So that's kind of one type, derivation, mathematical derivation. Number two is algorithms, pseudocode. This is where you have to be very clear to write down a set of instructions to solve whatever, Monte Carlo or finite differences or whatever. You've seen a number of algorithms in this course, right? Root finding, you've seen them all. You need to write down the instructions very carefully. The code, it doesn't have to be written in Python code. It can be in English. It could be a combination of formulas and instructions, bullet points. Okay, I'll be looking for very specific instructions. Maybe you need to run a loop. Okay, if you tell me I need to run a loop, well, how many times? When do I break out of the loop? How do I initialize parameters? What parameters do I need to be initialized? Okay, you can write that in pseudocode, bullet points, mathematical formulas. Use this formula to compute this quantity. Then use this quantity to compute this other thing. That's what I'm looking for, pseudocode. And the third one is kind of economic reasoning. Okay, economic reasoning is reasoning without the use of detailed mathematics. And it's not an algorithm. It's more economics. Okay, so things like put-call parity, understanding the limits of what a value can be. Can it be negative? Can it be more than 1? Can it be less than 1? Okay. For certain types of models, we saw stochastic volatility models. What do different parameters of this model do? You know, we saw the volatility, volatility of volatility, the correlation, all those parameters. What do they mean? What do they do? How do they affect the skew? What is the skew? Why do we get a skew? That's an economic reason, right? It's no mathematical reason. We used mathematics to represent it, but there were economic reasons why we had a skew. So it's kind of like those are the three sections, and really that's what I said on day one. There's a mathematical aspect, a computational aspect, and an economics aspect. And every single question fits into one of those. It's rare that it'll fit into more than one. Okay? And it should be easy for you to figure out just by reading the question what it is you're dealing with. If a question asks you, prove that this is the pricing formula, you know you're in number one, camp one. If you need to write an algorithm, it'll ask you, write down an algorithm. If it's not 1 or 2, it's 3. All right, any questions? Sorry, we had one here from earlier on.
I'd like to ask about what are we going to be provided through in the exam, since we are not allowed to bring our own cheat sheet? So in our slide, we have some, well, some formulas that looks very complicated. We need to rewrite them all, or just like the BS, and we just need to recite the basic one.
No, so I think as we've gone through the course, I've tried as much as possible to highlight the ones that you need to know how to derive. And when something's too complicated, I've been honest with you and said, look, you don't need to just learn that. You don't need to memorize this. So there were a lot of very complicated looking formulas when we did skew modeling. You know, like the de Peer formula. It's quite complicated. You saw the logic, but it's unreasonable for me to ask you to derive that in a class, in an exam scenario. Okay? What you will be provided with is just 2 booklets. You bring your writing material, bring your calculator, and we'll provide the question sheet and 2 booklets, and that's all you need. Everything you need will be in the question. Okay, so you have to exercise some intuition as to how far you need to go. Okay, yes, you need to understand the derivation of Black-Scholes. You need to be able to solve Black-Scholes. You need to be able to apply the numerical techniques like tree. You know, we did binomial trees, we did Monte Carlo, we did finite differences. All of those could come up. Okay? And I mean, if you ask me, every single formula we looked at looked complicated until you understood what it was doing. All right? So it's really that understanding. If you understand where a formula comes from, you can always rework it out. We'll give you enough clues to work it out in the exam. We're never going to ask you to write down a formula, as in recite it from memory. Never. Okay? Every question will give you a starting point, and you have to then be able to take that starting point to write down the steps, the logic to arrive at the final result. Does that help? Okay. Sorry, there was another one somewhere in the back.
The same question, yeah. I'm just wondering whether you will provide the formula sheet.
Well, there will be details in the question itself, but you're not going to get a cheat sheet which has some magical formulas on it. There's too many, first of all. And as I said, most of the formulas, most of the expressions, the complicated maths that we've looked at, I've never given you something without explaining where it came from. Okay? So use judgment. If some of the expressions were very complicated, I agree. Some of the expressions we saw today were very complicated, and I said, don't worry about these ones. Understand the intuition. Don't worry about the mathematics. But really, you could look at each of the expressions we looked at today, and once you understand them, you will be able to write them out yourself. There's nothing to it. Okay? Having said that, I know that week 12 and 13 were very intense. There are no problem sets for week 12 and 13. The points that I highlighted in terms of basic interest rate modeling, one factor, forward rates, the basics of credit, bonds, zero coupon bonds, basics of bootstrapping, that's probably enough. One more? No. Okay, other than that, there's one more request actually. So we're at the end of the course. And you guys get a chance to give your feedback. Let us know how you felt the course went. The feedback helps us improve the course. So there's a link on the Canvas page. So please go on, give your feedback. There's another 2 weeks. I'll send out another reminder in the next few days. But when you get a chance, please do send the feedback. And other than that, good luck in 2 weeks. I will be at the exam. I'll be invigilating. I'll be there to support you in case you have any questions. Just give it your best shot. Okay? You're all. If you've done the problem sets, if you follow the lectures, if you've thought about the material, you'll be okay. All right. See you in 2 weeks. Thank you.